Folks, we are looking at the collapse of the US dollar sometime soon, the collapse of the US dollar treasury system, the collapse of the US government, and major upheavals not only to the US, but the world governments and currencies and financial markets. I'm not speaking out of turn. I am using facts to tell you guys what is happening. Okay, this is Pablo. Here we go. Now, basically, this is one of those major issues that we're all looking at, but people don't understand what's going on. See, these are different Western governments, right? The debt collapse, and therefore the US dollar collapse of the United States government could come sooner, right? I didn't think this was going to happen, but it looks like it's going to happen sooner than we think. Here's the argument for a earlier collapse. Now, look at the UK, Germany, France, Austria. See this purple bar, right? That's 0 to 2 years debt, right? This yellowish bar, that's 2 to 5 years debt. Blue bar is 5 to 10 years debt, and green bar is 10 to 30 years debt. And this lighter purple, right? Lighter purple color is 30 plus years. And what do we notice about the USA as opposed to other countries, right? This is the government debt by maturity. When is it going to mature? As in, when do you have to pay it back? We notice, first of all, United States have nothing of this lighter purple debt, has nothing in the 30 plus years category. It, however, has, right? Like you compare Austria, France, they have some of these 30 plus year debt. And then you look at basically this bar. This is so much bigger than everyone else's in proportion to the United States, right? This dark purple bar, which is 0 to 2 years debt, right? That's percentages on the left. That's almost 44% of the US economy. All of that debt is due in the next 0 to 2 years.
And what about the 2 to 5 years, this gold bar, right? This lighter gold bar color. 2 to 5 years, right? US has quite a lot of that as well, about 23%, right? So 23% plus 43%, we're getting to 66%. So think about that, guys. That is a shocking statistic because when we look at all the other countries, they don't have this. US has basically 66% or 2/3 of all of its debt, US government treasury debt, coming due within the next 5 years. And 42%, almost half, 43% within the next 2 years. So it's not 2 years from now, but within the next 2 years. Could be 6 months, 7 months, 8 months, drawing out until 2 years is up. So right now, we all know before they lifted the debt ceiling, United States government owes folks around the world, investors, countries, $31 trillion. As soon as they lifted the debt ceiling, they've gone berserk. They've added another $1 trillion. It's now $32.4 trillion in about 45 days. Now, what's 43% of that, which is due, right? Which is due to be paid to investors within the next less than 2 years. That would be something like $15 trillion. But remember, they're paying about $1 trillion in interest every year as well. So that's $17 trillion that the United States will have to find to pay investors, lenders over the next 2 years. $17 trillion. To put into perspective, do you know how big that is that we're talking about? Basically, United States GDP is only about $22 trillion a year. And now they got to pay $17 trillion over 2 years. The entire taxes that the United States government collect is only $4 trillion per year. They spend about $6.8 trillion a year, and now they need to repay $15 trillion plus another $2 trillion of interest. $15 trillion principal plus another $2 trillion of interest. So that's $17 trillion. They only collect $4 trillion in taxes per year. So obviously, we all know how this is going to happen. We all know US can't pay for this, and it's going to do what it always does, which is borrow more money, right, to pay for the debt they have to pay to come into maturity now. Borrow from the future to pay for now. Okay, that's not the problem. The problem is this. Now, check this out. What interest rate will they be borrowing from? Will they be borrowing at? That is the big question, right? So, because in the next 2 years, when the United States borrows that money, right, again from the markets, the interest rate, look at this, it's going to be a lot higher than the last time it was borrowing that money. So, starting from around, say, 2009, 2010, 2011, US government has been borrowing at about 2% interest rate or yields. This is for the 10-year Treasury yield or less. Sometimes it pays about 2.5%, but rarely above that. Now, interest rates have shot up. It's around 4%. If the United States wants to borrow money for 2 years, it's got to pay 4.88%. That's almost 5%. If it wants to borrow money for 10 years, the market is demanding 3.95%, right? 3.95. And if it wants to borrow for 30 years, it's got to pay almost 4% for that, right? I don't make the rules, guys. That's what the market is telling you. That's very high compared to like the last 10 years. But however, if we look back into the 1980s, 1970s, interest rates were even higher, like at 11%, 8%, 10%, because inflation was high. Now, that's a downward cycle that's ended, like bull markets and bear markets. Now, interest rates might roar up again in the next 2-3 years. It might take a dip, but in general, this is looking like a bull flag, guys. Bull flag on the monthly chart, it could easily go to 7 or 8%. Imagine if the markets did that. Now, if that was to happen, what would happen to the United States? If that was to happen, then essentially, imagine someone who's already struggling under a lot of debt, right, has to borrow to repay that debt, and now they have to basically refinance and borrow again at much higher rates, which they borrowed from in the first place. Okay, no problem, because the United States has been playing this game forever. Maybe it can keep going, right? The question is, who will lend the United States that much money? Because it could easily blow. They estimate that $34 trillion could easily become $40 trillion or $45 trillion by the end of this decade or even earlier. Okay, so who has been lending the United States that money and who has been buying these US Treasury bonds? Let's have a look. Basically, we see countries like, let's have a look. Okay, these are the main countries. Japan, China, United Kingdom, right? Belgium, Luxembourg, they're buying. China is actually number 2 now. Japan's number 1, right? But however, as a whole, look at this. The total percent of debt, right, that's owned by foreign holders has gone from about 35%, 1/3, to, this is 2020. By 2023, right now, it's around here, right? It's basically about 21, 22%, right? It's getting to be 1/5 now. It used to be 1/3. So foreigners are, as a proportion of the total, holding less and less US debt. So who holds most of the US debt? Well, for example, we see China has been selling, even though since 2012, last decade, China has been growing quite a lot, but their holdings of US Treasury debt has gone from 1.3 trillion to 800 billion or so. They've cut about 40%. Japan is also selling just to defend the Japanese yen. They're not really trying to destabilize the US dollar. They're not trying to de-dollarize. They're more just trying to basically get some US dollars, sell the Treasury bonds, get some US dollars to push up their yen, because their yen has been tanking quite a lot. I'm sure you guys know this. So some of the largest buyers of US Treasuries are not buying now. China's not buying, Japan's not buying, and interest rates is very high. So who will be left to buy? Well, you might say, look, 70% of all buyers, right? 70% of all buyers of US Treasuries are domestic, meaning American companies or American individuals. So here, let's have a look at something called, so you think maybe the private sector, so like maybe insurance companies, banks might buy a lot of US Treasuries. But here's the problem, right? Have a look at this chart. This is CMBS, Commercial Mortgage-Backed Securities. When you get a mortgage to buy a house, that's called a residential mortgage, right? This is called a commercial mortgage. Why? Because commercial mortgage is when developers, like people like Donald Trump, when they build hotels, offices, industrials, that's like warehouses, or retail, shopping centers, malls, shopping malls. And guess when, again, maturity, when are these mortgages, commercial mortgages, coming due, right? 2023, 2024, we see massive amounts compared to, right, the future. So 147 billion, 115 billion, and then drops off to 69 billion, 49, whatever. Most of these are hotels, we see the red, right? Offices, industrial, and retail malls. So what does this mean if all these commercial real estate debt is coming due within the next year or two? Overall, what that means is you've got the US, they're going to need to refinance. All these shopping malls, all these commercial real estate offices and warehouses, they're going to have to go and ask the banks, US banks, to reloan them that money. So the US banks send their money to refinance these loans, right? And then how much money is there left for US banks to buy US treasuries? Now, let's not forget, US banks, a lot of them are going bankrupt. Why are they going bankrupt? We all know it's because they're going bankrupt in the first place because they bought too much US Treasury debt bonds to begin with. When they bought these US Treasury bonds, see this chart again. When they bought these US Treasury bonds, right, bonds were yielding like, let's say like the last few years, right? Bond yields were like 2%, 1%, 0.7%, 0.8%, 1.2%, whatever. And we all know this. When bond yields were low, then it means bond prices are high, right? They're inverse to each other. Yields were pretty low. Right now, yields have shot up to 4%. That means bond prices have tanked a lot, like some by 50, 60, 70%. So when that happens, basically what it means is that's why these banks are going bankrupt right now, or technically bankrupt, because they took all your money, your savings, your deposits, and they bought a lot of these government bonds because they're supposed to be safe, ultra safe, right? They bought them, like say $100 billion, right? And that $100 billion, because the yield's gone up, bond prices gone down, $100 billion in US Treasury bonds is now worth something like 50 billion. Not 100 billion, but 50 billion. Or even 40 billion. And now you've got people coming in, right? In a bank run scenario or a slow bank walk scenario, they're saying, give my deposit back, please. And the bank cannot give all that money back because it doesn't have it anymore because treasury bonds have collapsed. So in that case, when treasury bonds have gone down, a lot of these banks are going technically bankrupt. We've just had a fifth US bank go bankrupt on Friday or Thursday, I think. It's called the Tri-State Bank of Heartland Tri-State Bank, somewhere near Ohio. And they already lent a lot of loans to these shopping malls and these offices who are not doing well because people are working from home. And these commercial projects need to refinance, and the banks need to refinance them, because if they don't, then these shopping malls and these commercial real estate goes kaput. So the banks will try to refinance them. That's already a huge headache as it is. And the banks are already technically bankrupt or missing a huge portion of the depositors' money because treasury bonds already gone down. But now at the same time, the US government is going to be trying to refinance $15 trillion, or 43% of the entire US government debt in the next 2 years. That is a hugely crazy situation. So let's just sum it up here. US government owes $32.4 trillion, right? And a lot of that, almost half of that, needs to be repaid in the next 2 years, right? The US government doesn't have that money, so they're going to need to borrow that from somebody to repay that. They're borrowing money to repay their debt. When they borrow that money, they basically need to borrow 15 trillion, which is way larger than even the US government's entire tax income, which is 4 trillion. So, and China's not buying that debt, and Japan's not buying that debt, so they have to turn to domestic, as in US American investors. And American investors, such as the banks, are already, a lot of them going bankrupt or technically bankrupt because they're already holding a lot of those treasury bonds, and they've gone down a lot in value because yields have gone up. A lot of the insurance companies who buy these treasury bonds are also in a lot of trouble because they insure, their bond holdings, just like the banks, have also gone down a lot. So, and you have all these commercial real estate who are refinancing their debt in the next 2 years, and the banks needs to finance those guys, or else those guys, the shopping malls, the offices, the industrial real estate, where else they go bankrupt. If they're doing that, how do they have the money to also turn around and buy $15 trillion worth of US government treasury bonds? Keep in mind the US GDP per year is only $22 trillion. So therefore, there are about 2 or 3 solutions the government can do before this Titanic runs smack bang into the Titanic. The most responsible solution is, of course, to cut back spending, so the United States government doesn't need to spend that much money. To cut back spending, it would have to cut money it gives to the hospitals, to education, to the military, to social welfare. Do you see any of that happening? Can you imagine if they cut the military budget by 80%, or education budget by 50%, or Medicare or social welfare budget by 50%? It's not going to happen, is it? Unless something really drastic happens with the United States political system, which I don't see happening. It's probably like less than 1% probability. The other probability is if they just declare default. They just say, we can't pay it, we'll just default. If that happens, then instantly the US dollar has 0 credibility left, because you've just defaulted on your debt. US dollar crashes, United States Treasury bonds crashes, and although it's not a death sentence, it's still pretty bad. Imagine if you told your bank, hey, I can't pay my credit cards anymore, or I can't pay my mortgages anymore, I can't pay my car loans anymore, right? Imagine that happening to a country, right? Basically, US as a superpower, as a hegemon of the world, would end. So you don't want to do that either, right? That is not a good option either. The easiest way, the last and easiest option to solve this problem, and the United States has been doing this already, is quite simple. Is basically to get the Federal Reserve to print more money, what they call QE, essentially print more money so the Federal Reserve buys those bonds. They used to call it QE, quantitative easing. There are a couple of problems with that. One, what if inflation is still kind of high? If inflation, it may not be. In the next 2 years, inflation might get down to somewhere near 2%, which is Fed's target. If Fed started printing again, inflation would take off again. But what if inflation was still at 4%, still at 3.5%, or even 5%, and they started being forced to print money to buy those bonds because they don't have another option? Then imagine what that would do to inflation. That's only a small problem. The bigger problem is if that happened, more and more people like China, Russia, Brazil, South Africa, these BRICS nations are already trying to de-dollarize and come up with the BRICS currency backed by gold, which I don't necessarily think it's going to come out that fast, and which I don't think it's necessarily going to challenge the US dollar. There are a lot of problems with the BRICS currency as well. However, they're already trying to find a way to trade using the Chinese yuan or using their own currencies rather than the dollar. And then you come out and you say, we're going to print $15 trillion out of thin air, $15 trillion to buy the shortfall in bonds. What do you think that's going to happen? What do you think is going to happen to the markets? If that happened, which I don't see too many options around that, if that happened, then basically inflation would obviously go up. Is it going to be hyperinflation? Who knows? But inflation would obviously go up from where we are now, and everything else would go up as well. That means stock market would fly. The Bitcoin and crypto would bounce, make a massive bounce, and gold would rally into new highs. it's basically look at every time Fed made a huge, turn on the printer. Basically, the last time they did this in 2022 during the COVID pandemic crash, or during 2008, 2009, every time they did this, gold price took off, stock markets took off, Bitcoin and crypto took off. So this is good if you're holding on to assets, particularly hard assets. Maybe commodities will take off as well. Cash is probably going to be problematic in that situation. I'll have to update you guys when we come closer to that date. Certainly, this is, it's not just me who's seen this as a problem, even though if you asked me before, I would have said, when does the US dollar go down? I would have said it's a slow process, anywhere between 5 to 15 years. So if we are looking at the bell curve, where I am saying that it's anywhere between 5 years at the earliest to 15 years at the latest. If it was earlier than 5 years, I'd be surprised. If it was later than 15 years, I'd also be surprised. So somewhere in between. But now, just looking at the chart of so much US debt, right, this one, of so much US debt coming due in the next 2 years and in the next 5 years, I am worried. I'm like, how's the United States going to pay for that? They can't pay for that. So the only option is likely 98% likely they're going to have to get the Fed to print to pay for that. That means stock market will fly. That means the bonds will fly. That means the stocks will fly. The crypto, Bitcoin, and gold as well. The problem with all of this is it's not just according to me. Some, major players in US Wall Street financial markets are saying the same thing. This is BlackRock CEO. You guys can look him up. Basically, a lot of people think BlackRock controls Wall Street, controls world finance. They said transcend the US dollar, right? BlackRock CEO talks about Bitcoin, right? Makes crypto predictions for the Bitcoin, says it's going to transcend the US dollar. Now, you all know me, and you all know that I'm not a Bitcoin bull. But even I am seeing these signs where really huge players on Wall Street are worried about the United States dollar. Even they're saying, is there a hard international asset that can digitize gold? And they think Bitcoin can do that. However, it may not be the only option, because remember, BlackRock is creating the Bitcoin ETF. So you might be saying, oh yeah, so then Bitcoin wins against gold because they're not creating the gold ETF. Well, that's because BlackRock already owns the world's largest gold ETF. It's called the GLD. And those Wall Street guys have like about 5 or 6 gold ETFs, like Vanguard, State Street, Fidelity. They already have gold ETFs. So they already control gold. Now they're trying to say maybe they can control Bitcoin as well. I think they're worried for the US dollar. Not in the next 6 months or 12 months, but maybe 2 to 5 years, they can see that debt problem is going to be a huge problem. Who's going to finance? Who's going to pay for that debt? So Wall Street is worried. These really big guys like BlackRock's worried. So I am a little bit worried as well. I think over the next few years, anytime that Bitcoin basically takes a crash of say 60% or more, is a chance to dollar cost average in. The situation has changed. I wish I was wrong, but it looks like the way the United States Treasury debt is structured is basically a lot of it is at the front end, as in 44% of it is in the next 2 years, and another 24% in 2 to 5 years. So 2/3 of it, majority of it, is in the next 5 years. US is going to have a lot of problems trying to refinance that debt, as in borrow, from someone to repay that debt. So might be a good time to get into some hard assets. If you consider gold, silver, or Bitcoin as hard assets, then they probably will do quite well over the next, say, 3 to 5 years. Okay, so this video goes to my Discord first, as always, and then after a couple of days, I posted it to the public. Thank you guys. Tune in next time. This is Pablo. Catch you later. Bye.